Hello, everybody. Gbenga Olatunji here, welcoming you to GJAMES Associate channel. We want to look at some terminologies in finance and accounting world, the basics for that matter. We had started it before. We had looked at the A parts. We want to look at alphabet B, some of it, and C, as far as we can go, and ensure that this video is not too long. Bankruptcy. First of all, when we are talking about bankruptcy, is defined as compulsory administration of an estate of a person or an insolvent person by the court for the benefit of the creditors. Don't forget, in part A we spoke about adjudication order. So adjudication order is the order that permits the trustee of a bankruptcy proceeding to take over the assets of the bankrupt. So bankruptcy in itself is a compulsory administration in which the bankrupt loses the power to possess, and it goes right to those creditors that he or she is owing, or the insolvent organization is owing, so that they can sell it and divide the proceed accordingly. Then I think we can talk about business combination. And when we're talking about business combination, we are talking about arrangements where businesses which beforehand are having their separate organizations and endeavor run, but now they are coming together to exist as a single business with a common ownership. So we'll be talking about mergers and acquisitions. These are forms of business combinations which are very common in the business and finance world. Of course, cash is not strange to us in the finance world. When we are talking about cash, we are simply talking about whether the bank deposit, demand deposit, or cash at hand. That is cash, or any form of currency that is legal tender in the country. That is cash. Then we can talk about cash equivalent. And when we're talking about cash equivalent, we are talking about every other thing that we can sum together that could form cash, or that could be easily converted to cash. So a cash equivalent are short-term, highly liquid investments that are readily convertible into a specific amount of cash, and which are subject to an insignificant risk of change in value. So those are cash equivalents. Like our debtors, we can easily collect our money, and we can call it a cash equivalent, and so many other form of easily liquid items in the accounting and finance world. Cash flow, from cash to cash equivalent, now to cash flow. When we are talking about cash flows, basically we are talking about the inflow and the outflow of cash equivalents, the inflow of and outflow of cash equivalents. Then we'll be talking about cash flows. Of course, we have a statement, financial statement called cash flow statement, and basically it monitors the inflows and the outflows of cash and cash equivalents in the finance and accounting world. Then we can talk about control. Control in business world is unavoidable, and really, as a word in itself, people don't like the word control. People don't even like to be controlled. But in business and finance world and accounting world, control is a power, or power to govern the financial and operating policies of an entity so as to obtain a benefit or benefits from its activity. We say we have control or gain control over the organization. So when we have the power to govern the financial and operating policies of an entity in order to obtain benefit from it, we say we have gained power. And that control can be in form of business combination, mergers, acquisition, amalgamation, and the like, can give us control. Conversion. Let's talk about conversion from the word convert. When we are talking about conversion, we are talking about a process of expressing a foreign currency amount in local denomination and used appropriately by as rate of exchange or medium of exchange. So it's a process of expressing foreign currency, let's say for example dollar, by use of appropriate rate of exchange. Then we are talking about we've converted it, convert local currency to USD, to pounds, and the like. We'll say the currency has been converted. Then cost. Let us talk about costs now. When we are talking about cost in the finance accounting world, we are actually talking about cost of acquisition. It could be conversion costs. It could be any other costs that are necessary to bring the item of stock or anything we are talking about to its present state, location, and condition. So cost is associated with almost every endeavor. Almost every endeavor, cost is associated with it. So when we are talking about cost of purchase, cost of conversion, cost of bringing one thing or the other, like goods in transit, even transportation, we're talking about cost. Then also we can now apply it to another aspect of business, cost of control account. Cost of control account. And when we're talking about cost of control account, we could describe it as an account that we open to record the purchase of a business. Remember, we talked about business combination, merger, acquisition, and the like. So when we open an account for the purpose of business acquisition and the like, so as to determine whether the business is being purchased at a profit or loss, which we usually call whether it's being purchased at discount or at premium. That particular account is called cost of control account. Let us move on to credit risk. Credit risk. What is credit risk? When we are talking about credit risk, we are talking about finance world anyway. So it's the risk that one party to a financial instrument will fail or may fail to discharge their obligation or its obligation and cause the other party to incur financial loss. So credit risk is the risk that we bear when other party to a particular transaction did not oblige us or will not oblige us their own part of the deal, which make us to incur financial loss. So we say That is credit risk, and that leads us to credit rating. In the banking and financial institution world, we have credit rating, and some people, some organizations have high rating while some people have low rating. So why people have, or the organization have, high rating or low rating simply is because of the level of their financial commitment to the previous obligations that they've gone through. So those records pile up to become their rating in the society. Cross-sectional analysis. Let's talk about cross-sectional analysis. When we are talking about this in the analysis world, we are talking about comparison, like ratio analysis of a company with some other selected companies, but within the same industry and also at a particular point in time. It's a cross-sectional analysis. Comparison of ratios of companies, selected companies within the same industry, the same period of time. So say we are having a cross-sectional analysis. We can now talk about currency risk. Don't forget we have spoken about credit risk. Basically, currency risk is the risk that the value of a financial instrument, now we are talking about currency, will fluctuate because of change in foreign exchange. That is currency risk. When we perceive or preempt that the value of the financial instruments will fluctuate over time or in the nearest foreseeable future time as a result of change in foreign exchange, we say there's a currency risk. Of course, deferred tax. Let's talk about deferred tax. Let's talk about it in next video so that we can have the D dimension of our financial terminologies. From GJAMES Associate Channel, Gbenga, Olatunji has been speaking. If you are yet to subscribe, kindly subscribe, share this video so that others around you that may need it will be able to view it and listen to it too. From GJAMES Associate Channel, we'll be looking at the deep parts of our financial terminologies. We are value to life, we are value to your businesses.